Good morning, everyone. I'm Sampada, and I'll be walking you through the basics of fixed income securities. Um, yes, so let's start with some market insights. So, as on March 22, the total assets of the managed investments industry, which basically means that assets which are managed by a group of individuals, was approximately 57% of the GDP, or 1 lakh 35 lakh crore rupees, which is expected to more than double by March 2027 to 74% of the GDP. Um, we can also see from this graph that the net financial savings have increased from 45% in FY 2016 to 52% in FY 2020, sorry, in FY 2021, which basically means that we can see a shift from savings in physical assets to saving in financial assets. So what physical asset mean is gold, real estate, property, land. So we can see that there is a shift which is happening from savings in such assets to financial assets like mutual funds, debt, equity, FDs, etc. India's savings rate is higher than the global average percentage, which was 23.47% as of 2021, which shows a trend that Indians are willing to save. With a more investor awareness, there could be a possibility that this number might even go further. Just a minute. Yeah. So there is a skewed participation from the investor categories. Typically, retail investors prefer investing in traditional investments like bank deposits, equity and real estate, and also gold. FDs as an investment avenue, they offer very nominal returns and don't even help in protecting the investors from inflation. Equity is a very volatile asset class, and it's typically an investment for a longer time horizon and not from a medium to short term from a investment in a medium to short term duration. Gold and real estate are more of emotional assets than actual in financial assets, and they're very non-productive assets because they don't give like a return, like a fixed return throughout the holding. Fixed income securities, on the other hand, like bonds, can help in diversifying the portfolio, and they are also an investment. They also provide returns which are fixed in nature and over the period of the holding. Uh, Again, diversification of portfolio is key for all investments, depending upon the risk appetite, your age, your financial goals, your requirements, etc. So one must always diversify their portfolio according to their preferences. Um, we can see the trend of corporate bond spreads here over GSECs. So GSECs are basically government securities which are backed by sovereign guarantee, thus they carry zero risk. For AAA rated bonds, which are considered to be the highest in terms of degree in safety, we can see the spreads over GSEC of even these bonds. They are in the range of 50 to 60 basis points, which is proving that the bonds market are developing in India, and people are starting to shift from traditional assets to bonds. For a double A rating, similarly, the spread is about 150 bips, which is 1.5% over the GSEC yield. And for a A rating category, which is below a triple A, double A category, it is about 300 bips or 3%. So there are many initiatives to by RBI, by RFQ, EBP, etc., to develop the bond markets, and they have the trends show that the corporate bond markets have grown reasonably over the years. However, there is a lot of scope for improvement and for retail participation, because retail investors, uh, like I mentioned earlier, they are still more inclined towards traditional investments like FDs, but with investor awareness and such sessions, hopefully there will be a shift from traditional investments to bonds. So UB Invest. So welcome to the world of risk-free, rather lower risk and moderate returns. Though bonds are safe, but they're not completely safe. So we'll just look into what bonds are. So fixed income instrument cash flows, in simplified terms, what it means is that you get your principal invested and your interest at promised intervals. So say you invest in a bond today and it is a monthly paying or a quarterly paying or an annual interest paying bond, you will get your interest at those installments and your principal depending on what your underlying bond is offering. So it could be monthly, it could be quarterly, or it could even be at maturity. Calculation of bond price. So what a bond price typically is, it is the present value of future cash flows at the expected yield to maturity. So what that means is, to arrive at the bond price today, the future cash flows are discounted to arrive at that price. So let's consider this example. For a bond which has an annual coupon of 10% and that has fixed annual interest, that means that the interest is paid annually, of rupees 10 for 5 years, and bullet principal payment at the end of 5 years. So the principal is being paid at maturity at the end of 5 years, and the investor has a yield expectation of 11%, right? So to arrive at this yield, we have to understand at what price must the investor invest in the bond today to get a yield at the end of 11%. So this is the formula typically by which this derivation is done. And in Excel, it is very easy because you can simply use formulas like XNPV and XIRR for calculating the price and yield of the bond. Yeah, so let's talk about the inverse relation between price and yield of a bond. Like we know, the price and yield of a bond, they have an inverse relationship, which means that they move in opposite directions. For example, if the price of the bond is lower, if the price at which the bond is being offered is lower than the face value, it means that the yield that we'll be getting is more than the coupon. And similarly, if the price at which the bond is being purchased by the investor is more than the face value currently, it means that the yield on the bond will be lower than the coupon that is being offered. So it basically, they move in different in the opposite directions. So the concept of clean price versus dirty price. So the dirty price is basically the bond price plus the accrued interest. So this is the price which is paid by the investor when they go to purchase a bond. So accrued interest is simply the interest which is accrued from the last coupon date till the date of the transaction in the secondary market. The dirty price will always remain equal or higher to the clean price as the interest is added to the market price. On the date of the coupon payment, the both prices will always be the same. Let's look at this example. Sorry. Yeah. So if an individual has invested rupees 1000, for example, in a bond which has a coupon rate of 8% with a monthly payout, and the last interest payment was on 15th Feb, and he's planning on selling this bond in the secondary market on the 28th Feb, which means there is a gap of 13 days from 15th Feb to 28th Feb. So the interest for these 13 days is accrued to him, right? So this is the calculation for accrued interest, which comes to 3 rupees. So the dirty price for this bond, that is when an investor will go to purchase this bond, he will have to pay minimum 1003 rupees to purchase this bond in the secondary market on 28th of Feb. Then types of fixed income securities. So various types of fixed income securities. Let's start with government securities. There are GSEC strips, state development loans, SDLs, GSECs, which are government securities. Then in the money market instruments, we have treasury bills, commercial paper, commercial deposits. Then in the bonds, we have fixed coupon bonds, market linked debentures, zero coupon bonds, tax free bonds, perpetual bonds, subordinated debt. We'll cover these in detail in the next slides. Yeah. So government securities. So GSECs are bonds which are issued by the Reserve Bank of India on behalf of the central government, and they usually, the tenor for these bonds is from 1 year to 40 years. In this, the principal is repaid at maturity, and they offer a fixed coupon, and it is payable on a semi-annual basis. They are issued at face value, and because these are issued and backed by the government, there is no default risk, and these are considered to be completely risk-free instruments. State development loans. These are issued by state governments, and they carry a tenor of around 10 years and are issued by and are managed by the RBI. Again, in these, the principal is repaid at maturity, and the coupon is payable on a semi-annual basis. They are issued at face value and are considered to carry lower risk than the AAA rated corporate bonds. So SDLs are issued by the state governments to meet their fiscal deficits, and there is a certain proportion of such loans which the state governments can take. Then treasury bills, these are short-term money market instruments. So short-term would mean anything which is uh, less than 1 year. And these are issued by the Reserve Bank of India, and they have varying maturities like 91 days, 182 days, and 365 days. They are zero coupon securities, and which mean that they are issued at a discount, and on maturity, the face value is paid back. So the difference between the issue price and the maturity price, which is the face value, would mean the income that is earned by the investor. Again, this is issued by the government, so there is no default risk. So let's cover money market instruments. Money market instrument is a medium which is tapped by banks and corporates for raising money for a short duration. And they include treasury bills, certificate of deposits, and commercial papers. So commercial papers are always issued at discount and in denomination for rupees 5 lakhs. The maturity has to be less than 1 year. So it could be anywhere between, say 30 days to 365 days. And again, these are held in demat form. Certificate of deposits are issued by banks and financial institutions, corporates. The denomination is 1 lakh rupees. And again, because these are money market, the majority has to be less than 1 year. And these are also held in demat form. Non-convertible securities or corporate bonds, like we call them. So it's usually NCDs or corporate bonds are medium to long-term debt instruments which are issued by companies to borrow money. It's just like a loan, but in the form of a bond. These cannot be converted into equity shares of a company because this is a pure debt, and these are non-convertible instruments. Debt instruments have a fixed maturity date and a fixed repayment schedule, which is determined on the date of issuance itself. The NCDs, the non-convertible debentures, can either be listed or unlisted. Listed debentures, NCDs, they are duly registered with stock exchange. That is, they are listed on the stock exchange, and the issuers have to follow all the guidelines prescribed by SEBI in terms of regulations, reporting, corporate governance, etc. The minimum investment for a listed non-convertible debenture is 1 lakh. They are issued at a face value of 1 lakh post January 1st. Before 1st January, they were issued at a price of 10 lakh rupees. The face value was 10 lakh rupees. Some important aspects of bonds, so every bond that is issued, they have a specific number which is allotted to them, which is called the ISIN, which is the International Securities Identification Number. It is a 12-digit number, and it is peculiar. It is separate for each bond that is issued. So one can identify the bond using this number on the depository or on the exchange if it's listed. Demat account has to, so the bonds that are being issued now are compulsorily to be issued in a demat form. And it gets credited just like equity shares. It gets credited to your demat account with NSDL or CDSL. Secondary trades through the stock exchange, there is no settlement risk because the bonds are typically settled through the stock exchange. So what the exchange does is they do an order matching. So in case there is some discrepancy, the money will flow back to your account. So there is no risk of your money being lost anywhere. Then secured versus unsecured. So for secured bonds, at least 100% of the principal and interest is secured by, it could be secured by anything, by immovable property, assets, receivables, hypothecation of receivables by executing a deed of hypothecation, or there could also be a fixed deposit or an investment. In case of a default, the debenture trustee has a right to call an event of default, and they can liquidate the assets of the company on the security that is given upon liquidation. These are safer than unsecured bonds. Unsecured bonds, they do not have any assets that are backing as security. These are riskier than secured bonds since there are no assets to liquidate which are specifically allotted to them in case of a company going into insolvency. And because of this nature, they are generally higher. They are riskier assets. They are riskier bonds, and generally the interest offered on such bonds is higher. Generally, investors have a preference for secured bonds to, so that they know that they are secured rather than unsecured bonds. But investors who prefer going in for, say, a higher return could also consider unsecured bonds. Primary market versus secondary market. Primary market is the market wherein borrowers or issuers raise money directly. the money that they raise from such investment goes directly to the issuer, and they can utilize the funds as per the purpose that is permitted under the transaction. That could be for giving out loans for expansion, etc. They are invested. So bonds, for an investor who comes in the primary market, they invest at the coupon at which the issuer issues them. Listed bonds are always, they have to be rated by an accredited rating agency by SEBI, and they become tradable in the hands of investors in secondary market post investment in primary market. So whenever a primary issuance happens and the bonds are credited to the demat account of the holders, of the primary investors, these become tradable and can be then traded on the exchange. Secondary market is where the bonds get traded just like equity shares at prevailing yields. Indian stock exchanges, they do not have order matching system like equity. So for bonds, it is still a very underpenetrated market. So you need to find an investor and accordingly match it, unlike equity, wherein you can just place an order and your shares are sold. So continuous efforts are being made by the regulator to deepen bond markets, and this is where we come in and help, wherein we can match an investor, I mean a potential investor and a seller who wants to sell the bond. Further variations in NCDs. So NCDs again could be of various forms, starting from redeemable. So redeemable NCDs are payable on the expiry of the specific period, either in lump sum or in installments. So like I mentioned earlier, the principal can be repaid either monthly, quarterly, semi-annually, or annually, or directly only on maturity as a bullet payment. They are redeemed either at par or at a premium. uh, Typically, what we see, I mean, typically what happens is higher the tenor, higher is the risk and yield, because you're holding the security for a longer time with a lot of uncertainties. So the longer the tenor of the NCD, the longer is the higher is the risk and yield. Uh, Perpetual. So perpetual NCDs are they are perpetual in nature, which means that the principal is not promised to be paid on a particular date. However, they keep making regular interest payments throughout the life of the instrument, and it could be repaid, however, through the exercise of a call option or buyback of the instrument by the company, or it is repayable on the winding up of a company, or when the company chooses to repay the debt. So it is also considered as an equity in some form, but without any voting rights, or without any voting rights. Then listed. So, like I mentioned, the debentures could either be listed or unlisted. For listed, there is a higher liquidity in the market, in the secondary market, and tax efficiency. Issuer to disclose information in line. They have to disclose information in line with SEBI regulations. The financial results have to be submitted to the stock exchange on a quarterly basis. They would either be audited or unaudited or limited review, and they are to be submitted within 45 days from the end of each quarter. So this entails a higher level of reporting and compliance with regulations. Also, the entities who have listed debentures on any stock exchange, they have to publish financial results within 2 calendar days of the board meeting. So within 2 calendar days of the or in which the financials are being approved by the board, they have to be published on the stock exchange. For unlisted, it is not traded on. These are not traded on the exchange, but through the over-the-counter market. Talking about the parties that are involved in a primary listed NCD issuance, we have the issuer who is proposing to raise money by way of an NCD. We have a rating agency who has to provide a valid rating to the rate or to the debentures. We have the legal counsel who helps in drafting and finalization of transaction documents and the placement memorandum, which is basically the offer document. We have SEBI and Stock Exchange, which SEBI for following all the regulations and compliances, and Stock Exchange for getting the in principle approval, and the final listing also happens on the Stock Exchange. We have the depositories, which could be either NSDL or CDSL, through which we get an ISIN, which is the 12-digit unique number, like I mentioned. Then we have a valuation agency in case of an MLD. We have a debenture trustee who acts on behalf of the investors and will take all actions on behalf of the debenture holders. We have a registrar and transfer agent, an R&T agent who license with the depository. So an R&T agent is a link between the issuer and the depository. Then we have the investors and the debenture holders who are ultimately investing in the NCD. Rating categories in India. So the rating categories in India vary from AAA with the highest safety to D, which is a default category. So AAA is considered, so instruments which have a AAA rating are considered to have the highest degree of safety regarding timely servicing of financial obligations, and they carry the lowest credit risk. After AAA, we have AA, A, triple B, double B, B, C, and then D. D is the lowest category, which means that the entity has or is likely to default soon. Bonds versus equity. So bonds have capital protection. They are debt and they get repaid before equity. In case of winding up or liquidation of a company, bonds always get preference uh, above more than equity. They have a stable cash flow and assured returns, and so we know that we are going to get our interest and principal at the fixed intervals, like mentioned in the transaction. They are less susceptible to market sentiments as compared to equity. So equity is very volatile, and the prices can change drastically even within a day. But bonds are less susceptible to these market sentiments. Um, like I mentioned, we have priority in cash flows in a liquidation scenario. So the bonds will get repaid first. Tax-free bonds are tax-efficient products which have a higher post-tax yield. Um, there is an ability in bonds wherein we can structure and invest in an instrument that provides cash flows as per requirement, like depending on our preference of tenor, amortization, etc. These instruments can be structured, and there are various structures that are available in the market depending on the investor's preference. The disadvantages are lower liquidity in secondary market, especially in lower rating categories, because typically below AA or say A or triple B categories, because these are lower rating categories, the risk is higher. So not all investors prefer investing in such lower categories of rating. Retail investors, due to say lack of investor awareness, they have the participation that is expected from retail investors has still not reached the required potential. So there is a lot of scope for retail investors. Higher ticket size as compared to equity. Like I mentioned, the minimum, the face value of the debentures is 1 lakh for listed, and it could be lower, maybe say 10,000 for unlisted. But again, for equity, which starts, like a single equity share can be purchased at say 1,000 rupees. So there's a lot of difference there, and because of that, equity, the ticket size is relatively higher compared to equity in debt. Uh, Again, bonds versus fixed deposits. So higher yields. Bonds give real positive returns and beat inflation. Fixed deposits continue to offer fixed return, which does not go in line with inflation, how the inflation is. Uh, like again, tax-free bonds, they provide a higher post-tax yield, flexible investment option depending on risk appetite, sector, and credit preferences. Again, we can structure the cash flows as per requirement in bonds, which we can't do in fixed deposits. They have a fixed repayment pattern. Disadvantages: lower liquidity, especially lower rating categories, like I mentioned for bonds. And also because fixed deposits are traditional form of investment, they are considered relatively safer. Uh, Access is difficult for retail investors. Retail investors traditionally prefer investing in fixed deposits because those are considered safe form of investment. Prices of bonds may fluctuate on account of movement in interest rates and change of credit profile of the issuer. If the credit profile of the issuer deteriorates, or so there could be so there is a little uncertainty there. Um, so we as a platform, we provide access to cherry pick credits. So we do our own credit, and we also facilitate secondary market liquidity. Major risk in fixed income instruments. So inflation. We all know that inflation is the general increase in the price levels over a given time. Since most fixed income securities do not have an adjustment to account for inflation, rising price level eats away at the purchasing power of the cash flows of the fixed income securities, making it a risk for investors. Uh, Interest rate risk. So the change in interest rate can also have a is also a risk for investors. So, for example, if an investor is holding a 10-year bond that pays 3% interest, but then the interest rates rise and there are new bonds being issued which offer a better rate of interest, then the investor holding the bond which is paying a lower rate of interest becomes less valuable, and obviously the price of that security falls in the secondary market, and the preference is given to the bond which is paying a higher interest. Default credit risk is the risk wherein it is a risk on the credit worthiness of the borrower. So it depends on a number of factors, and while the rating depicts the level of the level of risk that is involved with a particular borrower, but this could change with like we've seen in instances like DHFL and so on. Then downgrade risk. This refers to the risk that the bond issuer's creditworthiness declines, causing its yields to reduce. Right. So when the rating of a bond is downgraded, so it is basically that the creditworthiness of the issuer is downgraded, which means that the repaying capacity is being questioned. So, however, in most of the corporate bonds, they have a built-in covenant which causes a coupon to increase in case of a rating downgrade, providing a hedge to the investors. Then liquidity risk. Since we do not have a robust secondary market yet for corporate bonds, taking an exit from bonds before maturity might become a challenge or may be required to be done at a high yield. So we help overcome this issue for deepening the bond markets. Uh, we did some research on the default rate of bonds by gathering data that was available in the market, and what we have observed is that for the period from financial year 2012 to financial year 2022, across rating categories like AAA, AA, and A, so for a 1 year, default rate has been 0.25% for AAA. Even though AAA is considered the highest, it has the highest degree of safety, but we can still see this number because there were certain black swan events during this period, like demonetization. There was change in the regime. There were, events like ILNFS and DHFL defaults. Then there were COVID cycles, etc. So due to this, there is some level of default that has happened even in AAA categories. So over a 1 year period, it was 0.25, and over a 3 year period, it was 1.03%. Whereas for an A category rating, for a 3 year period, it was close to only 2.48%. So it means that it shows that bonds are relatively safer given the low default rates over this 10 year period, and they do give fixed consistent returns and are safer than equity investments.
Yeah. So, hi everyone, I am Shreya and I look at investor relations here at UB. So now as we have got a brief walkthrough of the fixed income securities, I am going to walk you through some of the high yielding opportunities that UB has to offer via our UB Invest platform. So at UB, our game is to majorly look at A to AA minus rated entities where the credit of the entity is strong and where we think there is a lot of juice for our partners to make. So to start through, I would walk you through the credit of Spandana Spurti. Sampada, if you can move the slide. Yeah. So Spandana Spurti is a Hyderabad-based NBFC which provides small ticket unsecured loans to women of low income households in rural and urban areas for income generating activities. So Spandana began the journey in 1998, and within 5 years, the company grew to become one of the largest microfinance institutions in India, and they have presence over 18 states and across 1120 branches. So if we talk about their product portfolio, they have basically 4 offerings to provide. The major large chunk of their cash flows come from Abhilasha loans, which are 1 to 2 year tenured loans given to women of low income households for setting up and expanding income generating activities. So these loans provide for repayment typically on a bi-monthly and weekly basis, and they constitute of about 96 to 97% of the total product portfolio. Then they also provide loan against property. So they give loan against mortgage of residential houses or commercial shops with a monthly repayment structure. So here the loan tenure again somewhere ranges from 12 months to 60 months, and this constitutes of about 1.59% of the total product mix. They also give loans such as interim loans, where the tenure is again 1 to 2 years, and these loans generally assist the borrowers to meet the short term liquidity requirements. They are generally considered as a top up loans, which are given to existing borrowers to meet their working capital needs, seasonal requirements, or certain emergency needs as well. Again, these loans constitute a very small portion of the portfolio mix, about 0.53%. So if we broadly see, the Abhilasha loans only constitute of about 97%, while the rest of the product mix is generally given again loans against properties or gold loans or interim loans. If we look at the financial numbers of the entity, the company has given a stellar performance in the quarter 3 of FY23. There is a 29% quarter-on-quarter growth in the PAT to a 71 crore number in quarter 3 FY23. And as of quarter 3, the AUM also stands at 6,852 crores. The company also displays a low level of NPA and GNPA, with the same being around 2.5 to 5.3% levels. In this particular quarter, the company also saw a very strong momentum in disbursements. So here in this case, the quarter-on-quarter growth in the same was being more than 70%, that is around 2,300 odd crores in quarter 3. And continuing in that positive financial announcements, the collection efficiency of the company also continues to be stable at around 102.1% and in the north of 102% itself. And the the capital adequacy ratio also remains healthy at around 40-45 odd percent. So if I have to speak about the issuance that we have done, so we have closed a high yielding A-rated issuance for this entity, where the residual tenure for this entity stands at 15% and the printed coupon is coming at around 1083 XIRR. So the cash flows will go according to 10.83% XIRR, and an all-in that we provide to our partners would come at around 12.5%, depending on the quantum and the relationship. So we usually deal in such sort of issuances where we believe that the entity name is very strong and there is a lot of juice for our partners as well. Next entity that I would like to walk through would be Muthoot Microfinance. So Muthoot Microfinance is part of Muthoot Papachan or the Muthoot Blue Group and is an RBI registered NBFC MFI. So the company is focused on providing microloans to women entrepreneurs with a focus on rural regions of India. They have presence in about 17 states with 755 branches. Prominently, they have higher concentration in 3 states of Kerala, Tamil Nadu, and Karnataka. Muthoot Microfinance also leverages the infrastructure and branch network of one of the promoters, Muthoot FinCorp Limited, for loan disbursements, collection of receipts, and collections of and processing fee, insurance, etc. The company largely caters to rural populations, semi-urban and urban areas, and mainly lends to income-generating activities like agriculture, animal husbandry, microfinance, and etc. So if I talk about their product details, their product portfolio is again divided into 3 segments. So they give loans under livelihood solutions, where there is again income and dairy generating loans. Then they give loans under life improvement segment, where they offer loans for education, mobile, solar, etc. And then the third one is health and hygiene. Again, the company has a very strong financial position. They have an AUM of 6,238 crores, while the net worth being around 1,300 odd crores, and the entity is profit making in nature, which wherein the PAT as of financial year 2022 stands at 46 odd crores. The rating of the entity stands at A plus, and if I talk about the issuance that we have done for this entity, we have closed a 16-month residual tenure high yielding structure for them, where the coupon at the issuance is 10% XIRR, and for the partners, we will be providing at 11% XIRR. So this structure would be a bullet payment structure, where at the end of the maturity of the towards the end of the maturity, the investor would be getting the entire amount. Lastly, we also have done something for Arman Financial Services. Sampada, if you can change the slide. So if I talk about Arman is a Ahmedabad-based NBFC, which was again incorporated in 1992, and the company also made its IPO in 1995, which had received an overwhelming response from its public issue and was oversubscribed by 22 times. So the company largely provides financing for all models of motorcycle, mopeds, scooters, etc. And while the company does have 7 branches for this business, majority of the two-wheeler business works from the dealerships. So the company secures business from a network of around 60 dealers. The customers are attended by the company staff present at the dealers' offices. And Arman's two-wheeler and MSME operations are spread across prominently across Gujarat and Madhya Pradesh, although most of the 90% of the loan portfolio comes from Gujarat only. So talking about some key financial numbers, again, the company has shown a stellar 9-month FY23 performance with a 273% year-on-year increase in PAT. They have booked a profit of 58 odd crores while having an AUM of 1642 crores, which is again showing a 57% year-on-year growth. So the company also displays a low NPA and GNPA number, which with each being around 0.2 to 3.4% respectively. The company also displays a steady and healthy collection efficiency, with each month being around north of 98.2%. In addition to their strong performance and strong governance, the company is also backed by some key marquee investors such as the Elevations Capital, with their shareholder being around 22.3% in the company, and other foreign investors such as Singapore-based 16th Street Capital and US-based 7th Canyon Advisors. The company also displays a healthy liquidity position with around 754 million in cash or bank balance liquid investments, and the company has also duly repaid all the debt obligations that were due in Q1 FY23. So some of the key lending consideration or the key strengths about Arman Financial Services would be the vintage of the organization. So Arman has been operating in Gujarat market for more than 2 decades now and has demonstrated a long track record of operations through various business cycles. So they have a strong foothold in the major state of operations, resulting in a business expertise. Secondly, if I talk about governance, so the company is promoted by Jayendra Patel, who has industry-wide experience of more than 2 decades, and he is again supported by his son Alok Patel, who is actively involved in the business. So such sort of experience management is very widely appreciated when we have to evaluate NBFC, and hence this is also a key strength for Arman. The company also has moderately diversified resource profile with a mix of lender base, including PSU, private sector banks, and has raised debt through NCDs, CCs, etc., term loans as well. Also, being a listed entity, the company has a flexibility to raise debt from capital markets to support its cost of borrowing. To avoid the geographic concentration risk, the company has also started to venture into geographies like Haryana and Bihar while consolidating its presence in existing states like Gujarat, UP, Rajasthan post COVID. So now if I have to talk about the issuance that we have closed, so we have taken into consideration the retail segment while doing this issuance, and hence we have kept the face value for this issuance at around at 1 lakh face value. So we have closed it 18-month residual tenure paper where the coupon would be 990 XRR, and an all-in we are providing to our partners would be at around 12.5%. So the rest of the differential amount that is there, the partners uh, can mark it as a fee for themselves, and the rating for the security would remain at Acuity A minus. Uh, so Soumya, I think we have covered largely most of the topics for discussion. If there are any questions, it's most welcome. We can actually share the recording of this session for PPT. I think, Soumya, you can answer if we can share the PPT as well. So minimum ticket size for most of the issuances currently stands at 10 lakhs. However, there are certain issuances where the ticket size is 1 lakh and 10,000 as well. However, for trading on the platform, BSE platform, you would require a minimum ticket size of 2 lakhs. The minimum investment amount, Rabindranath sir, would remain at 2 lakhs if we have to do on-market transaction. As I was explaining, for some of the structures that we have closed before Jan 1st, 2023, the ticket size would remain at 10 lakhs for the previously known as MLD structures. However, post 1st Jan 2023, we have some 2-3 structures where the ticket size would remain at 1 lakh as well. So for Arman Financial Services, the ticket size would remain at 1 lakh. So one question is that fixed prices for the distributor to sell to his clients, or is his margin at his discretion? So your margin would be at discretion. All UB will do is we can give you the rate at which we will be offering to you, and then it is up to you on what levels you want to offer to your client, and that is the rest of the differential amount you can raise it on us as invoice and we will clear it, or you can take the entire stock on your books and then pass it on to your client. So both the models, we work on both the models. So Rabindranath sir, to answer your question, how can we invest through online? I think my team would have reached out to you regarding our new platform called as UB Invest. So through that platform, you can see what all UB has to offer, and you can make an offer there. And if the stock is available, you can directly invest through our platform online, and the transaction would settle on the BSC exchange itself. So you have to place a bid through our online platform, and the entire settlement of the transaction remains at BSC. Hi, Heth. We do have MLD structure, but however, since MLDs, I mean, post budget, there is no such thing as MLDs. We are naming those structured as bullet payment NCD structures. But we do have that sort of structure if that is what you're asking. Sankadeep, so to adding to your question, how much risk is involved? So just to give you some sort of clarity, most and Sampada can add on to it. Most of our issuances that we do are secured in nature, and a large part of our issuances that we did were also principal protected in nature. And most of the entities that with for who we raise money, these entities are the entities with who we have a lot of comfort and we have a lot of skin in the game. So the risk involved there is so I mean, as Sampada also explained, there is some sort of risk involved in every instrument, but we have large comfort on these names, and the structure is in such way that the risk is minimized to a larger extent.
But just for clarity, we can always refer to the rating and the nature of the instrument before making a decision to invest.
Is there any tax benefit? No, post budget, all the instruments would be taxed uh, in the according to the personal tax brackets.